Robschild, thanks for tuning in. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said millionaires don't need astrologers, but billionaires do, and so we begin. Today is Thursday, August 22nd, 2024. Today's episode, I'd like to start with a brief discussion on semiconductor supply, a discussion and a warning. We'll start this conversation with taking a look at Nvidia, everyone's favorite stock these days. I've been referring to this company in many of my videos, and this is where we start our conversation. The market cap of this company is a whopping $3 trillion. You would need to pay its current valuation, supposedly, if everyone sold their shares at $123 a share today. The total value of the company, of all the shares put together, is $3 trillion. The dividend yield, 0.03%. The PE ratio is 72. $72 earns $1 of earnings right now. And a 0.03% dividend is the equivalent of earning 3 cents for every $100 that you have invested in this. 3 cents. Meanwhile, in government treasury bonds, you can get $4 or $5. So Nvidia is making lots of money. They're making more and more money, but relative to its price, those earnings are very expensive. 72 is a very high PE ratio. Very strong, good companies out there normally trade in where you want to buy a company for a decent valuation is around a traditional PE ratio of around 20. Benjamin Graham recommends buying under 20 and then also under the average earnings of the past 10 years, looking at a PE ratio of 25. So that includes previous years with lower earnings averaged into the PE. So if this company, we're just going to say, if this were to drop to a PE ratio of 20, it's more than a 2/3 decline. It would lose over 66% of its current value. Now, if you are invested in the S&P 500 in VU or SPY, you own Nvidia stock. In fact, it's one of your top holdings. It is 6.7% of the entire value of VU, the entire value of SPY. If this were to drop by 2/3%, the entire S&P 500 would drop by about 4%. And this is just one company. But Robschild, Nvidia is just going to make more and more money because we need more and more semiconductors. Well, we do until we don't. Notice how this company is making enormous amounts of money and the shareholders aren't getting any of it. Where's the money going? It's being reinvested into the company. The company is expanding. It's growing. It's using that money to produce better and more chips. There are other companies competing with this company that are also producing more and better semiconductor chips. Imagine a world where everyone is making semiconductor chips, so much so that all of a sudden, we have more semiconductor chips than there are grains of sand on the earth. You can go to the beach and scoop up a whole pile of them. What do they become worth then? How much money can you make off of semiconductors once we've overexpanded and start making too many of them for what the market needs? Yeah, you want to keep making more and more of them because you're making lots of money from it until it goes the other way. This is the problem with 1929. Before the Great Depression, people thought that the railroads were going to expand infinitely, and they didn't. Cars took over a large portion of what was going on. There were, too many railroad companies battling each other, and there wasn't an infinite growth that was going to happen in the railroad industry. And then the Great Depression happened. Now, can that happen today with semiconductor chips? Yes, I think it could. So there you go. You've been warned. The rest of the episode will go through just what I see in charts. There's not a whole lot of things that happened today, but we did see pretty big reversal candles in the S&P 500 and the NASDAQ. A slight pop in the VIX. We also saw Fed Funds futures push out the double cut. We'll take a look at that. Notably, 10 a.m. on Friday, we have Powell speaking. And, they've already released their minutes, so I don't expect anything monumental coming out of this speech. But, if he seems like crazily dovish, then the market could get excited or maybe worried. Who knows what'll happen? Can't see it. Daily reminders, 2-year, 10-year yield curve is past its second birthday. This is important. This suggests a recession or a depression is coming, especially after it uninverts. It happens every time like clockwork, and somehow every single time we eventually get to the point where everyone stops believing that the yield curve inversion matters. We're all like, oh no, it doesn't matter anymore. Everything's fine. That's when the real stuff hits the fan. And like I've been saying, the market kind of had to kill all the bears first, and they've been killing a lot of bears. Are all the bears dead? I don't know. I'm not, and I'm a bear. I bought puts on SPY today, actually. I see the decline coming from here on out. Add to that, the SOM rule has been triggered. It's not untriggered, it's triggered. The unemployment rate is going up at a pace that suggests that we are already in a recession and things will be spiraling out of control very soon. Quick additional reminder for my show, this is not investment advice. Please don't take anything I say as investment advice. Reversal candles are kind of like a Pac-Man that eat up the last few days. When you see it open higher than the previous day and then the market just drives it down throughout the day, it means the bears are strong. They are very, very strong. Today's red candle was a very strong one. If you just look back in the past, to understand how this works, when you have a market going up, okay, so where my mouse is right now, you see, I'll try to scroll in more in case your screen's kind of small. If you see a jump down, that's not really an engulfing candle. That's not really super bearish, and it didn't turn out to be. It kept going higher, right? We have this candle, it engulfed one day, not 2 days. And then we keep going up, and then the real kicker was this one. This is a large red candle that engulfed these 2 days, and what happened afterwards? We tumble down, 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 right? Okay, so we have another red candle here, but it didn't engulf the two. We didn't open higher than these 2 days. We opened lower and went down. So that was that doesn't count as an engulfing reversal candle. So then we go up and up and up and up, no big red candles, and we see one here. It engulfs 1, 2, 3, 4, 5, maybe even 6 days. That's very bearish. And what does the market do immediately after? It drops. Notably, it didn't drop a ton there, but it sort of provides momentum for things to go that direction in at least the near future. And then we go up, no big red candles, no big red candles. This one almost engulfing. It didn't really engulf this tail on the first one. This one does engulf the previous day, but not the past 2 days. And then this whole crash here, it happened too quickly to engulf anything. But anyway, this candle right here that we have today engulfed very clearly the past 2 days on the SPX, S&P 500. So this is very formidable. It looks like it wants to keep going down from here, and it would make sense in terms of what I've been sort of smelling out here, a head and shoulders here. and we did not break the previous high. So I do think this is the top here. I think we are headed down here to form the right shoulder, and if we do and we break this line and confirm, the market should be going much lower here. Same thing going on in the Qs. This is it looks like the same exact chart, right? But this is the NASDAQ 100, same thing. Head and shoulders, big red engulfing candle, probably marks the top, just like this previous one. Big sell-off, here it is. I fully expect this to roll over here. Speaking of semiconductors, this one's even more bearish looking. This red candle is engulfing the past 4 trading days, which is it's gonna shove momentum. At the very least, will be going down in the very near future. But I do expect this pattern at this point to play out the way I've been saying. I noted recently, after this epic, historic Japanese carry trade yen blow up situation happening. Some people think it was something else, apparently. The way I see it is that does it matter? Does it matter what caused it? I mean, it's like there's a slowdown coming here. Like, it's pretty obvious. Oil selling off, unemployment's going higher. I mean, the yield curve is still inverted. That's not normal. And like I said in a few days back, talking about, like, imagine a house full of canisters, and one of them just blew up, and there's still kind of a fire. And I've been talking about how the VIX, it really exploded on that crazy, crazy day. And since then, we kind of ski sloped just straight down so nicely back to where we were. And now it's funny, we're sort of like going up, like, very, very smoothly here. It's amazing how smooth looking this chart is here, and it makes me wonder if we're just gonna smooth right into another blow up. I wouldn't be surprised if it does happen very soon, really. Interesting things going on in TNX. This can help us determine where longer rates are going, to determine where something like TLT might go. So pattern wise, I have been talking about, like, okay, is this the pattern here that we see? Is this a bear flag? So this is the pole and this is the flag, or is this a channel here? A downsloping channel after a pole going up this way, which actually would suggest that there still is a chance of yields breaking higher here. So this is quite the battle zone going on right here in yields for the short term. I was expecting it to roll over a little faster here to the downside. So it looks like we're pausing. We want to play around in this area until we get some more powerful news, I guess, to determine whether rates are going to be going back up from here or further down. No credit risk, though. HYG sitting at a very high price relative to everything that's going on. With the sell-off of TLT and this thing only dipping a little bit today, it's almost like credit spreads tightened even more today, all while the S&P 500 showed, and the Qs showed a lot more weakness. It's interesting. Always keep your eye on those junk bonds. When this falls apart, that's when it's like, for me, that's when it really spells like time to maybe run for the hills. But, this is the thing. We went down into the yen carry trade blow up. It looked like we were going to just go for a huge crash here, and instead we had just the craziest rally of a lifetime, I guess you might call it. One other way to put it is, you gotta kill the bears. I mean, if you have too many people bearish, you have too many people on one side of the boat, they're gonna get squeezed out until, they're out of their positions. Markets are brutal. We'll see how this plays out. I wanted to bring up the Fed funds futures. I said in the beginning of the video, I said Fed funds futures push out the double cut. What I mean by that is we were pricing in sort of a triple cut between the September meeting and the November meeting, but now we're seeing only, as of today, we're seeing only one cut for September, one cut for November, and then two cuts in December. So they pushed out the double cut another month. Pretty interesting. That's all from me today. Rather, that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.